What's up, everyone? Welcome back to the channel. If you have ever tried predicting the market solely based on a higher time frame bias, you know that your bias isn't always going to be correct. The mistake a lot of traders make is that they establish a bias on a higher time frame and jump immediately to seeking an entry. This lack of timing causes you to force trades and take unnecessary losses when your initial idea was wrong. Today, we are going completely mechanical. I'm going to show you exactly how to frame your daily bias using liquidity pools, and then how to mechanically confirm that bias using specific daily session profiles. Grab a notepad, because we are transitioning you from being someone who blindly predicts the market to someone who executes a step-by-step process with reason. The absolute easiest way to frame your draw on liquidity or establish your daily bias is by using the previous day's high and the previous day's low. These areas act as massive liquidity pools that can either dictate a continuation or frame a total reversal. We can also look at the previous week's high and low to frame these exact same reversal points or draws on liquidity. What we are specifically looking for is a failure to displace over these key swing points. For example, if price reaches up into a previous day high, but fails to displace above it, and instead closes back inside the range, we can frame a reversal. This creates a setup known as the next day model. When price takes a swing high and closes back inside the range, the next day model tells us to anticipate that the next daily candle will be bearish, specifically an open, high, low, close candle. Once that bearish bias is set, your immediate draw on liquidity becomes the previous day low. You hold this directional bias until your draw on liquidity is met. Conversely, if price sweeps a previous day low and fails to displace below it, your next day model bias becomes bullish, anticipating an open, low, high, close candle targeting the previous day high. Now, just because you assume price should go higher doesn't mean you immediately and blindly take an entry on the open of the next candle. We need a filter that shows us our bias is invalid times before times we jump into an entry and take a loss. That is where daily profiles come in. To confirm our bias, we are going to break the daily candle down into its three main sessions: Asia, London, and New York. To get a clear, higher time frame perspective without the noise of lower time frames, we apply these sessions to a 7-hour chart. This 7-hour time frame captures true session logic and gives us exactly 3 candles per day to profile. The 18 candle represents the Asia session, the 1 candle represents London, and the 8 candle represents New York. The data behind these sessions is crucial. The Asia session has very low average volatility and only makes up about 17% of the average daily range. London sees a slight spike in volatility, making up 23% of the daily range. But New York has the highest volatility of the day, triggered by 8:30 news events and the 9:30 open, ultimately making up a massive 60% of the daily candles range. Even more importantly, the Asia session only closes in the direction of the overall daily candle 58% of the time, and London only 62% of the time. They are barely better than coin flips. The New York session, however, closes in the direction of the daily candle a staggering 86% of the time. Because of this data, our very first universal rule is to allow the 18 Asia candle to print entirely without you participating in it. It has low context and a very low likeliness to expand, making it a low probability time in the market. Instead, we use if this, then that statements, observing the development of the 1 London candle to give us the full perspective on what we should demand from the New York session. There are 3 main profiles we want to confirm before executing our entry. 1, the 18 reversal. This is when the 18 Asia session sets the intraday extreme, and the 1 London candle expands away from it. If London breaks away and continues the move, we assume the market is already in continuation, and we seek an 8 New York candle continuation. 7-2. The 1 reversal. This happens when the 18 candle consolidates or makes a run against your bias. The 1 London candle then runs out the Asia range and reverses in the opposing direction. Once this intraday reversal is established by London, we look for the 8 New York candle to expand in continuation. Number 3, the 8 reversal. This scenario occurs if the 18 and 1 candles fail to establish an intraday reversal and instead consolidate or form an opposing run. When this happens, we know exactly what to demand. The New York session must form a new intraday high or low, run out that liquidity, and then expand off of it. Finally, you must know when to walk away. There is a full invalidation scenario that applies regardless of whether your daily bias is bullish or bearish. If both or one of the 18 and 1 candles make a massive expansion through the overnight session, they can capture the entire range of that daily candle. When this outlier expansion exhausts the daily range before New York even opens, there is no room left to capitalize on. Large opposing runs with massive wicks do not support expansion, and this development means the trade is fully invalidated. To put it all together, use the next day model to frame your daily bias based on failures to displace over previous day highs and lows. Then drop down to a 7-hour chart to map your daily profiles. Let Asia print. Use London for context and execute your trades precisely in the New York session when the profile confirms your bias. If you use this system as a bridge between your ideas and your entries, you will finally start thinking and acting like a structured professional. All right, let's get right down to a live example of this. We are starting off top down on the daily chart. Take a look at the higher time frame context. The market has been heavily bullish, and we have an obvious draw on liquidity resting right here at this daily high. That is our ultimate target. So to align ourselves with this price action, we need to drop down a time frame to profile our overnight sessions, Asia, London, and New York. Let's move down to the 7-hour time frame. Look at the 6 p.m. candle. Asia gave us a tight consolidation range. And if Asia is consolidating, what do we mathematically expect from London? A manipulation. Right on cue, see here? London drops down to sweep that range. There is our manipulation. So if we have Asia consolidation followed by London manipulation, what is New York going to do? It's going to give us the continuation. Let's align ourselves with that exact move. Dropping into the 4-hour chart, the picture gets even clearer. We have a solid consolidation range right here, combined with a clean SMT divergence. This sets up our 6 a.m. candle as a C2 closure, which tells us we are fully expecting the 10 a.m. window to deliver that upside continuation. To pinpoint the execution, we move to the 1 5-minute time frame to align with our 4-hour bias. Look closely right here. We get a clear change in state of delivery, or CISD. The price aggressively closes above the prior down close candle, validating our order block. Now, notice the time. We still haven't even hit the 9:30 a.m. equities open. But because our higher time frames are perfectly aligned, we have the confidence to take a positional entry once the 8:30 a.m. candle closes above that down close candle, confirming the CISD. We enter exactly on the opening of the next candle. Your stop loss goes safely below those recent lows, and we target a strict mechanical 2R trade. And boom, look at that delivery. We melt straight to the upside and hit our TP with zero stress. This right here is why we trust the models and let the higher time frames dictate the narrative. Asia consolidates, London manipulates, New York expands. It is advanced price action at its finest. If this breakdown helped you see the charts a little clearer today, smash that like button, subscribe to VTrades, and I will see you in the next one.